VUG ETF, Growth Investing Powerhouse. VUG tracks the top large-cap growth stocks in the US, but is it all sunshine and rainbows? We'll break down the good, the not-so-good, and everything a pro investor needs to know about VUG. By the end of this video, you'll know if VUG deserves a spot in your portfolio and how to use it like an investing champion. So, buckle up, hit that like button, and let's chat VUG. Question 1. What is VUG? VUG is an ETF launched by Vanguard in 2004. It seeks to track the performance of the CRSP US Large Cap Growth Index, which consists of approximately 250 of the largest, most growth-oriented companies in the United States. These companies are typically characterized by high revenue and earnings growth, and are often leaders in their respective industries. Question 2. How does VUG work? VUG is a passively managed ETF. This means that the fund manager does not actively select individual stocks. Instead, the fund holds all the stocks in the underlying index in proportion to their market capitalization. This approach aims to replicate the performance of the index, minus the expenses associated with running the fund. Question 3. What distinguishable features does VUG ETF offer to investors? Some key features of VUG ETF include: diversification. VUG provides exposure to a diversified portfolio of large-cap U.S. growth stocks, reducing single-stock risk. Low expense ratio. Vanguard is renowned for its low-cost investment products, and VUG is no exception, boasting a competitive expense ratio. Passive management. VUG follows a passive investment strategy, aiming to replicate the performance of its underlying index rather than actively selecting individual stocks. Dividend reinvestment. Investors have the option to reinvest dividends automatically, potentially enhancing long-term returns through compounding. Question 4. What is the investment strategy of VUG ETF? The investment strategy of VUG revolves around tracking the CRSP US Large Cap Growth Index. This index is composed of large-cap U.S. stocks demonstrating growth characteristics, such as high earnings growth potential and price momentum. VUG invests in a portfolio of stocks that mirrors the composition of this index, aiming to closely replicate its performance. Question 5. What are the benefits of investing in VUG? There are several potential benefits to investing in VUG. Diversification. VUG provides exposure to a diversified basket of large-cap growth stocks, which can help to reduce portfolio risk. Low cost. VUG has a low expense ratio, compared to many actively managed funds. Convenience. VUG offers a convenient way to invest in a broad range of growth stocks, without having to research and select individual companies. Potential for high returns. Growth stocks have the potential to generate higher returns than the overall market over the long term. Question 6. What are the risks of investing in VUG? It's important to understand the risks involved before investing in VUG. Market volatility. Growth stocks tend to be more volatile than value stocks and the overall market. This means that the value of your investment in VUG could fluctuate significantly over time. Concentration risk. VUG is concentrated in a specific sector of the market, large-cap growth. This means that the performance of the fund could be more sensitive to sector-specific factors than a more diversified fund. Style risk. Growth stocks may underperform value stocks or the overall market in certain market conditions. Question 7. How does the composition of VUG ETF's portfolio change over time? The composition of VUG ETF's portfolio evolves over time in line with changes in the CRSP US Large Cap Growth Index. Vanguard periodically rebalances the portfolio to maintain alignment with the index's constituents and weights. While the frequency of rebalancing may vary, it typically occurs quarterly or semi-annually. Question 8. How does VUG compare to other similar ETFs? Several other ETFs track similar indices and offer exposure to large-cap growth stocks. Here's a brief comparison of VUG with two popular alternatives. VOOG, iShares SP 500 Growth ETF. VOOG tracks the SP 500 Growth Index, which includes a broader range of companies than VUG, around 350, but also some smaller cap stocks. VOOG has a slightly higher expense ratio, 0.10%, than VUG. MGK, iShares Mega Cap Growth ETF. MGK focuses specifically on the largest and most well-established growth companies in the U.S. It has a lower expense ratio, 0.7%, than VUG, but also a smaller number of holdings, around 150. Question 9. Are there any factors investors should consider before adding VUG ETF to their investment portfolio? Before investing in VUG ETF, investors should consider factors such as investment objectives. Ensure that VUG aligns with your investment goals and risk tolerance. Portfolio diversification. Assess how VUG fits into your existing investment portfolio and whether it complements other holdings. Expense ratio. While VUG boasts a low expense ratio, investors should compare it with similar ETFs to ensure competitiveness. Market conditions. Consider prevailing market conditions and economic outlooks, as these factors can influence the performance of VUG and the broader stock market. Alright everyone, that's all the time we have for VUG today on Chat ETF. Remember, VUG offers a powerful way to tap into large cap growth, but it's not without its considerations. Don't forget to like this video, subscribe to Chat ETF for more in-depth ETF analysis, and leave a comment below. Let us know what other ETFs you'd like us to dive into next. Thanks for joining the conversation, and happy investing!